What's up everybody, Gen X Dividend Investor here. In this episode I'm breaking down how closed-end funds work, why they often have higher yields, and the key risks you need to understand before investing. I'll also highlight two closed-end funds that have actually outperformed the S&P 500 over the past 10 years. And to finish up, I'll share a couple interesting comments from subscribers that are worth reflecting on, so make sure to stay until the end. Okay, so some investors really like closed-end funds, aka CEFs, because they often pay higher yields than ETFs. But is the risk worth the reward? Stay tuned and I'll give you my 2 cents. This video actually came from a suggestion by a subscriber named Hike Bike Home, and beyond that, I've been getting a lot of comments about CEFs lately. Like on my last video about what I'd do differently if I could go back in time, someone commented, "For real dividends, try closed-end funds." They continued on saying that Walmart doesn't really count as a dividend stock and that a good CEF pays out way more in dividends. He said that in response to me mentioning that one of my regrets was not buying Walmart years ago when it was first suggested to me. So let me take a quick detour and first show you why I feel Walmart is indeed a great dividend stock, though I understand his point that it's not yielding much in dividends right now and never has as compared to most CEFs. Then after that I'll launch into CEFs, but feel free to use the timestamps on screen if you want to skip ahead. Okay, so there are a bunch of reasons why I think Walmart counts as a great dividend stock, starting with its stellar dividend history. In fact, this year they declared their 52nd consecutive annual dividend hike, making them a dividend king. They announced a massive 13% dividend increase, which is well above the rate of inflation, driven by strong business performance. And since stock prices often follow earnings, Walmart's share price has also climbed. It's been rising even faster than the S&P 500, which has pushed its dividend yield down to just 1%. But if we look back 10 years ago, we can see that Walmart had a starting dividend yield of 3.32%, so pretty respectable for a blue chip company. Thus, like most investments, when you buy really matters. I mean, had you bought Walmart 10 years ago and reinvested dividends, you would have achieved a 392% total return, which is 50% more than the S&P 500's 255% return, and you'd have a yield on cost at around 5%, which sounds a lot better than 1%. Beating the S&P 500 by that much over a 10-year period is awesome, especially for a classically boring blue-chip dividend stock. And about 86% of your return came from dividends, so that's a meaningful amount. Another reason I consider Walmart a great dividend stock is because of its business model. I mean, people shop at Walmart in good times and bad, which helps keep its cash flow strong and dependable. That reliability supports consistent dividend payments, even when other companies are forced to cut back. Plus, it's the world's largest retailer, giving it many significant competitive advantages. Its scale and highly efficient supply chain allow it to negotiate favorable terms with suppliers and pass savings on to its customers. This makes it a top choice for price-conscious shoppers, especially during economic downturns. That steady demand and operational strength enable Walmart to generate healthy profits, maintain a good payout ratio, and comfortably fund its dividend while continuing to invest in long-term growth. And all that is why I consider it a great dividend stock. Leave me a comment and tell me if you feel Walmart is a good dividend stock, or if you're in the camp that it's not really one. That all being said, if your main goal was passive income right now, then Walmart might not make sense for you, and going with a higher yielding closed-end fund could be more compelling, so let's talk about them. A closed-end fund is an actively managed investment fund with a fixed number of shares that trade on a stock exchange. I'll explain what I mean about fixed number of shares and why that's important in a moment. CEFs often hold a mix of assets, including stocks, bonds, REITs, and others. And why do income investors often talk about CEFs? Well, because they tend to pay higher yields than most traditional funds. So your next logical thought should be, well, how can they do that? And there are 3 main reasons why. Number 1 is leverage. Some closed-end funds borrow money to purchase income-generating assets, which can boost returns when markets are doing well. However, borrowing also increases risk since losses can be magnified if the market turns against them. It's similar to using margin to invest more, which is something I personally avoid. But by borrowing at a lower interest rate than the return they expect to earn, these funds can amplify the income they distribute to shareholders. Number 2 is because CEFs often invest in higher-yielding assets, though higher yield tends to mean higher risk. Those assets can include things like junk bonds, preferred stocks, MLPs, credit markets, etc. And finally, reason number 3, some closed-end funds trade for less than the value of the assets they hold, which is like getting a $100 gift card for $80. This unique feature directly impacts your yield. So to understand what I mean, we have to distinguish between a closed-end fund's net asset value or NAV and its market price. The NAV is the per share value of the fund's underlying assets, meaning what the fund actually owns. However, because CEF shares trade on a stock exchange, their market price is determined by supply and demand, and it often differs from the fund's NAV. When demand for a CEF is high, its market price may rise above its NAV and is known as trading at a premium. When demand is low, the market price may fall below NAV, which is called trading at a discount. This pricing behavior creates both opportunity and risk. While investors may find value by purchasing a CEF at a discount, they also need to be careful not to overpay when a fund trades at a premium. For example, suppose a CEF's portfolio generates $1 in income per share each year and its NAV is $20. That would mean the yield based on NAV, which reflects the true yield of the underlying holdings, is 5%. Now imagine the CEF is trading at $18 per share, reflecting a 10% discount. If you buy the fund at that price, you're still receiving the same $1 annual distribution per share. Your yield on the amount you invested would be $1 divided by $18, or approximately 5.56%. In other words, buying a fund at a discount allows you to earn more income for each dollar you invest, which increases your yield. However, just because the fund is priced below the value of its assets does not mean the market price will eventually rise. The discount might continue for a long time, or could even grow wider. So while the higher income is real and immediate, any additional gain from the price moving closer to the fund's NAV is uncertain. That pricing dynamic, where you can pay less than NAV, is one of the reasons closed-end funds can offer higher yields. It's not only about how much income the fund produces, but also how much you pay in relation to the value of the assets it holds. And now that we understand all that, let's highlight a key difference between traditional ETFs and closed-end funds, which is that CEFs have a fixed number of shares while ETFs do not. ETFs are open-ended, which means new shares can be created or removed from the market based on investor demand. When more people want to buy an ETF, new shares are issued to meet that demand. When people sell, shares can be taken out of circulation. This ongoing process helps keep ETF's market price very close to its NAV. But closed-end funds work differently. After a CEF is launched, usually through an IPO, the number of shares stays the same. The fund does not create new shares when demand increases and does not remove shares when investors sell. And because the supply of shares is fixed, the fund's market price is based entirely on what buyers are willing to pay and what sellers are willing to accept, which is why a CEF's market price can trade at a premium or at a discount to its NAV. So why does all that matter? Well, when you buy a share of an ETF like VU, you can be fairly confident that you're paying a price that closely reflects the value of the companies inside the fund. That's one of the reasons why ETFs are so popular, i.e. it's because they're generally priced in line with the assets they hold, not to mention they're simple and transparent. But with CEF, the situation is different, and that difference on a CEF's price relative to its NAV creates opportunity, but also introduces risk. That's why understanding how the fixed share structure works is important when deciding whether a closed-end fund is the right fit for your investment goals. A few other key differences between ETFs and closed-end funds are also worth calling out. Like ETFs tend to be passive, often tracking an index, while CEFs are usually actively managed by professionals. That active management is one reason why CEFs typically come with higher expenses. Another difference with CEFs is that they sometimes can hold illiquid or more complex assets like municipal bonds, business development companies, or global infrastructure, which aren't usually found in typical ETFs. Plus, ETFs rarely use leverage, whereas CEFs often do, which can amplify both returns and risk. Leverage usually works out better in low-rate environments or bull markets, but tends to perform worse in high-yield or bear markets. And finally, another big difference is that ETFs tend to offer lower yields, while CEFs are known for providing higher yields. That being said, there are some ETFs with big yields. Bottom line, ETFs are usually great for low-cost, long-term investing with stable and transparent pricing. CEFs tend to be more appealing to income-focused investors who are comfortable with the added risks that come with leverage, price volatility, less liquidity, and the other things I called out. Now, I mentioned business development companies or BDCs, and they're actually somewhat similar to CEFs. I mean, like CEFs, BDCs have a fixed number of shares and trade on public exchanges. But instead of holding traditional stocks or bonds, BDCs focus on lending to small and mid-sized private companies, often acting like publicly traded private lenders. They tend to invest in riskier, less liquid businesses and often use leverage, which can lead to higher income generation. Some people see BDCs as even more speculative than CEFs. Anyway, another interesting difference between ETFs and CEFs is how frequently they tend to pay out. Like the majority of ETFs, especially those tracking broad indexes like the SP 500, distribute dividends every 3 months, as that matches the payout schedule of most of the underlying companies or assets they hold. But many CEFs pay their distributions monthly, which is attractive to retirees or income-seeking investors who prefer more frequent cash flow. Another difference to be aware of between ETFs and closed-end funds is how their distributions are taxed. While both can pay income in the form of dividends or capital gains, CEFs are more likely to include return of capital or ROC in their payouts. ROC can be tax efficient because it often defers taxes by returning part of your original investment. This lowers your cost basis without triggering immediate tax. ROC is generally considered good when it doesn't reduce a fund's earning power, such as when it results from accounting practices like depreciation or unrealized gains. However, if a fund consistently returns capital because it isn't generating enough income to cover its distributions, ROC may signal that the distributions are unsustainable. Over time, this can erode the fund's net asset value, hurt long-term returns, and is sometimes referred to as destructive. If you hold a CEF in a taxable account, your year-end 1099 div form should show a breakdown of how your distributions are taxed, usually separating them into ordinary income, qualified dividends, capital gains, and return of capital. This breakdown helps you understand both your tax liability and potentially whether the income you're receiving is sustainable. Compare that to ETFs, which rarely distribute return of capital. Their income typically comes from dividends or interest earned on the underlying holdings and is usually taxed as ordinary income or qualified dividends, depending on the asset class and how long you've held the fund. Because ETFs are usually more tax efficient in both structure and the type of income they generate, they're often favored by investors in taxable accounts who are looking to minimize tax liability. So a logical follow-on question would be, what sort of account types are best for CEFs? Well, generally speaking, it depends on your goals, but broadly speaking, I'd say that because of their income-heavy nature and unique tax characteristics, they're best suited for tax-advantaged accounts like traditional IRAs or Roths. CEFs often generate taxable income like ordinary income or short-term capital gains, which can lead to a higher tax burden. So holding a CEF in an IRA lets you capture those high yields and compound the income tax-free. Plus, you can shield yourself from annual tax reporting on distributions. One quick side note is that if your CEF holds MLPs and you have it in your retirement account, then you should double-check its prospectus or tax disclosures to confirm that you wouldn't be subject to unrelated business income tax. Anyway, CEFs can also make sense in taxable accounts for some people, such as if you need the monthly income or if you're looking to take advantage of potential discounts to NAV and you understand the tax implications. And you may have to deal with return of capital tax management, not to mention paying tax on your distributions. One option to consider for taxable accounts is municipal bond CEFs, which sometimes offer federal or state tax-free income. And note, most 401k plans don't allow direct investments in CEFs. Moving on, another key difference between ETFs and CEFs is trading volume. ETFs generally have high trading volume, with many buyers and sellers throughout the day. This strong liquidity helps keep the difference between the buying price and the selling price small, which makes it easy to move in and out of positions quickly, even with larger amounts. CEFs, in contrast, usually have much lower trading volume. This can lead to wider bid-ask spreads, which may increase trading costs and make it harder to enter or exit large positions efficiently, even with today's modern brokerages. And that lower trading volume can also contribute to greater price swings. The market price of a CEF may fluctuate more than the actual value of its underlying assets, driven by factors like investor sentiment, news, or changes in interest rates, even when the fund's holdings remain relatively stable. And one final thing I'll call out is that closed-end funds can sometimes be harder to fully understand than ETFs. With ETFs, it's usually pretty clear what you're investing in and how they generate income. But with CEFs, it can take more digging to figure out exactly what's behind the distributions. Like, is it earning real income? Is it paying out capital gains? Is part of the distribution coming from return of capital? All those details matter, and they're not always obvious at first glance. That can lead to confusion, especially for newer investors who may assume all distributions are income, even when some of it could be their own money being returned. It also doesn't help that different CEFs follow different strategies, use varying levels of leverage, and disclose information in different ways. So to really understand what you're buying, it often takes reading through fund reports, distribution breakdowns, and other materials to figure out whether the income is sustainable or just being manufactured to attract investors. Bottom line, CEFs can offer attractive yields, but they require a bit more due diligence to understand what you're really getting. And with all that being said, what are some example CEFs that have outperformed? Well, check out Adam's Diversified Equity Fund, ticker ADX. Over the past 10 years, it's delivered an impressive total return of 312%, outperforming the SP 500, which returned about 256% over the same period. ADX is a publicly owned investment advisory firm founded back in 1929, and it manages assets for investment companies. That kind of longevity is rare and speaks to its stability. It has a reasonable expense ratio of 0.59%, pays distributions quarterly, and offers a yield of nearly 8.5% with around $2.8 billion in assets under management. Even more impressive, the fund has paid distributions for over 90 consecutive years, which is a great sign for income-focused investors. That said, there are a few risks to keep in mind. Some of the distributions may come from capital gains or return of capital, which can reduce the fund's net asset value over time if not managed carefully. The fund also has significant exposure to technology stocks, making up about 32% of the portfolio, along with a focus on large cap growth. That kind of concentration could make it more vulnerable if those sectors take a hit. It apparently doesn't use leverage, which I like. And like many closed-end funds, it trades with lower volume than most ETFs, which can result in wider price spreads and a bit less liquidity. The real question is if its outperformance can continue. Another thing to be aware of is its volatile payouts. Check out its dividend payout history on Seeking Alpha to see what I mean. And obviously do a lot more research before ever investing, as I'm only touching on a few aspects of these CEFs. Moving on, another interesting CEF is Eaton Vance Enhanced Equity Income Fund 2, ticker EOS. Seeking Alpha says it's got a 10-year total return of 263%, beating out the SP 500's 256%. It's got a high expense ratio at 1.09%, it pays out monthly, and has a 7.55% yield, along with $1.24 billion under management. The fund primarily invests in growth stocks of mid-cap and large-cap companies. It generates earnings from option premiums by selling covered calls on a substantial portion of its portfolio, which can mean limited upside potential. It has some concentration in growth and tech stocks, as 44% of its portfolio is in the tech sector, and some of its distributions consist of ROC if income or gains fall short. That can gradually reduce NAV if not replenished. All interesting stuff to potentially dig into more. Now before I move on, I asked you to leave a comment and tell me if you own any CEFs, and if so, which ones, as that sort of info is always interesting to read. And if you don't own any CEFs, tell me if you're now thinking more seriously about potentially getting into one. If I ever did, I'd probably limit it to 5% of my portfolio, as that aligns to my risk tolerance in retirement. Okay, let's switch gears now, and I'll show you a couple subscriber comments that I felt were worth sharing and reflecting on. The first is from someone named StockJock1222. He commented that life is a cruel teacher. You get the test first and the lesson after. He went on to share his investing regrets, like not holding on to stocks through tough times. And I think a lot of us can relate to what he wrote. I mean, investing often gives you the test first, whether it's a market downturn or a difficult decision, and the lesson only becomes clear afterward. In this case, it was the regret of not holding on to stocks during tough periods, which is something many of us have experienced. It's a powerful reminder that some of the most valuable lessons come only after we've gone through the tough experience. And then I thought this comment from RL7329 is also worth sharing. He basically pointed out that buying Bitcoin early was much easier said than done. At the time, it was a technical, risky, and uncertain process, and most people either didn't know how to get it or didn't trust it enough to try. His comment is a great reminder that hindsight often makes the past seem simpler than it really was. It can blur just how difficult and unclear things felt at the time. And that reminds me that investing often requires conviction. You have to be willing to act when things are messy, unpopular, or uncertain. It's easy to sound smart when looking back, but what really matters is having the courage to make decisions when the outcome is murky. In my experience, the best investment opportunities are sometimes the ones that feel the most uncomfortable. They take patience, conviction, and a willingness to take a risk when nothing else feels certain and most people are doubtful. It's like running toward the fire while everyone else is running away. Sometimes you do get burned, but sometimes you make the right call and it ends up looking obvious in hindsight. And hey, speaking of bold moves with uncertain outcomes, here's one that's guaranteed to pay off, which is to hit that thumbs up button, subscribe if you haven't yet, and click the bell notification. Now I'd like to shout out my newest Patreon aristocrats, so thank you Kimeko for signing up. I'd also like to thank Neil MCK82 for signing up. Next I'm going to shout out my 5 Gold Star channel members, i.e. the ones that have been members for a year or more. So thank you Brett Cherry, Truth, Scott Goodwin, Steve Doxa, and Keithman5000. Moving on, now I'd like to show my gratitude to subscribers who've left really nice comments, so I'm going to shout out 10 who've done just that. So thank yous go out to John Garber, Greg B2, Richard M441, Wilco P1390, Jose J. Ka, Drew Smitty92, Drifting into Retirement, Sab CHOW4TP, IS Soga 2125, or is it La Soga 2125? And then multiple nice comments from Ex-Strategic Investor AI. Thanks folks, I really appreciate it. Now I'd like to recommend that folks check out my Seeking Alpha affiliate link, which often has a nice discount when new users sign up. Next I'll pitch my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment even if they sign up for a full year. Also check out my Patreon page and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.